Hello and welcome to AI Market News by LM. There's a certain nervous energy in the air this week, a feeling that's just rippling from Tokyo all the way to New York. It's this deep sense of uncertainty, and it's got investors heading for the exits. So today, we're going to dig into what's driving this fear, why it's all happening right now, and what critical signposts we all need to be watching for next.
Right, if we had to just boil down the market's mood to one single word, it would be this: fear. This headline, it just perfectly captures the emotion that's driving a really broad sell-off. This isn't contained to just one sector or one country. It's a contagious feeling, and it's causing a major retreat from risk pretty much across the board.
And just look at the sheer breadth of this thing. We are seeing deep red everywhere. Japan's Nikkei, it took a more than 3% nosedive. The wider MSCI Asia Pacific Index is down over 2%. And that pessimism, well, it's bleeding right into the US session, with S&P 500 futures pointing sharply lower. This is not a local problem. This is a global flight to safety.
So what lit the fuse? What was the thing that turned a little bit of caution into outright fear? Well, it looks like it all started when Bitcoin, which is a key barometer for market risk appetite, sliced right through that critical psychological $90,000 level and landed right here. Now, just let that sink in for a second. In a flash, every single dollar of gain that Bitcoin made this entire year, gone, wiped out. When a leading risk asset capitulates like that, it just sends this powerful shockwave of negative feeling through the entire financial system. And that brings us to the most important question, right? We see the selling, we've pinpointed the trigger, but what are the deep currents that are actually fueling this widespread fear? Let's break it down. Okay, so the anxiety we're seeing in the market right now really boils down to three key drivers. We've got some serious nervousness in the high-flying tech sector, a ton of uncertainty around what the Federal Reserve is going to do next, and then there's this looming threat of contagion from the crypto world itself. First up, let's talk about the AI trade. The long-term bull case is pretty undeniable, right? This is a massive technological shift with huge growth potential. But the problem is the here and now. The bear case is gaining a lot of ground, pointing to valuations that have just become, well, lofty, maybe even unsustainable. Investors are starting to ask some tough questions, like when will these companies actually make money? And a lot of them are deciding it's probably time to take some profits off the table. And this little detail, it really highlights the nervousness out there. I mean, when a titan of tech investing like Peter Thiel liquidates his fund's entire stake in a giant like NVIDIA, right before earnings no less, it sends a really powerful signal. The so-called smart money is getting defensive, and that makes everyone else start to reevaluate their own risk. Now let's move on to our second driver, the Fed. Okay, on the surface, this quote from Fed Governor Christopher Waller should be calming some nerves. He's making a pretty clear case for a rate cut in December, which is typically something markets love to hear. It suggests the Fed is ready to step in and support the economy. But here is the major disconnect. Despite Waller's pretty dovish stance, the market itself is completely divided. I mean, look at this. Traders are pricing in a 50-50 chance of a cut. It is a literal coin toss. This deep split just shows how uncertain the path forward really is. The market has zero conviction in what the Fed will do, and if there's one thing markets absolutely hate, it is uncertainty. And that brings us to our third driver, the crypto market's role as a risk proxy. Here's why this matters, even if we don't own a single bit of crypto. The wider market sees assets like Bitcoin as a bellwether for overall risk appetite. So when Bitcoin sells off hard, it's a major warning sign that investors are dumping their riskiest holdings first. The danger here is a negative feedback loop. A sharp drop in crypto can trigger margin calls, and that forces leveraged investors to sell other assets, like their tech stocks, just to cover those losses. This creates a nasty spillover effect. As one analyst put it, crypto is the canary in the coal mine. And because there's such an overlapping investor base between crypto and high-growth tech, the pain in one market can very easily spread to the other. All right, so we've unpacked the what and the why. Now, let's turn to what comes next. What are the key signposts this week that could either finally calm the markets or just pour gasoline on the fire? And let me tell you, this week is absolutely packed with potential market movers. We're going to be hanging on every single word from Fed officials all week long, searching for any clues about that December rate decision. Then on Wednesday, all eyes will be on NVIDIA's earnings. That's a critical health check for the entire AI boom. And finally, Thursday brings the US jobs report, which is a pivotal piece of data that will heavily influence the Fed's thinking. So that leaves us with the billion-dollar question, doesn't it? We are at a crossroads. Will the data we get this week provide the clarity needed to calm these markets down? Or is this sell-off just the opening act for a much deeper correction? We'll be watching very, very closely. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.